This is Pete Moore on Halo Talks NYC. I have the pleasure of having one of my longtime friends in the Halo sector join me. We're going to do a crash course on private equity and growth capital, bringing to you live from San Diego, Eric Epstein, E2 Ventures by way of Manhattan Beach, by way of Hawaii, and back to me. What up?
Peter, always a pleasure.
Always a pleasure. Let's just air it out to end up the first day of the trade show. First of all, give everyone a quick background. How long you've been in private equity, putting deals together, and then we're going to talk about some interesting stories along the way.
All right. Well, hey, Pete, I appreciate it. We're here down at Ursa having a good time. San Diego's never been colder. Again, my name's Eric Epstein. I started in private equity in 1993 in New York City. My first job was at the Blackstone Group, believe it or not, 30 years ago. Started out there for a couple of years. I worked with a couple private credit funds after that, and then I was in the private equity group at Cerberus Capital for 10 years in New York and in Los Angeles and California. And so I've been doing this for a while. At the moment, I act as an independent sponsor, so I work without a dedicated private equity fund, but I have many relationships with family offices and the institutional capital partners that will partner with me on transactions in which I pursue, and I spend a lot of my time within health, wellness, and fitness, which is why we're here at this one of my favorite trade shows.
Halo.
I love the Halo.
It's called the Halo effect. So Eric and I have been friends for at least 15 years now, I'd probably say. And you've been one of the early investors in whether it's bricks and mortar, franchisor, franchisee. You know, as you look at different business models and you say, hey, that's interesting, I want to get in on the ground floor like you're in on the Crunch deal, which I'd say is kind of the ground floor on the franchising side. What are some of the things do you look at and that are important to you? And maybe like if you were to prioritize, like I got management, I got EBITDA, I got unit economics, or, you know, give me like a laundry, you know, short list of like, if they don't check these boxes, I'm not interested.
It's a great question. So first, let me tell you what I don't do, which is people who know me, I'm a health and wellness fanatic. And the first thing I try to do is as someone who's very passionate, and I guess I'll say on the leading edge of identifying trends, is I want to make sure that my own personal passions, I don't confuse good economics and good transactions with my own personal passions. So the first thing I try to do is make sure that my perspective is actually balanced and moderate and not based on some of my extreme passions within the sector. So that's actually the first thing I do. But no, on a serious note, look, there's so many different areas within the Halo umbrella, if you will. So, look, within, you know, I am a Crunch Fitness franchisee in the Northeast, and so I've had an interest in multi-unit for many, many years. As you know, you look at the unit economics and find out where there's opportunities. You know, I pursued a number of planets over the years early on, you know, kind of well before the private equity consolidation and before valuations went absurd. Was always kind of cover bid on transactions I pursued in that area, but was very compelled with the HVLP thesis along with those unit economics and sought opportunities after Planet, and so Crunch was actually a natural fit. And I did lead a recapitalization of a rapidly growing platform in the Northeast in January 2020. So that was wonderful timing right before COVID.
That's when it closed, the original?
Yeah, we closed that January 2020. And, you know, there was a number of HVLP deals that were done right prior to COVID. And so, you know, a lot of our initial excitement and enthusiasm quickly waned, you know, 60 days later. And I have some other colleagues within private equity who also closed deals within a short period of time of the onset of COVID. And we traded a lot of war stories, you know, throughout the initial term of COVID. And thankfully, you know, most of us, particularly within HVLP, have bounced back quite nicely. But obviously that's only one area within Halo. I mean, I love enthusiast consumer brands and other just, you know, rapidly growing brands that have, you know, a real franchise around them. And so what does that mean? That means it's something that isn't just a fad. It's something that has a nice growth curve and, you know, adoption curve to it, and something that has good gross margins and becomes scalable over time, and something that is more than a product, you know, hopefully a product line where you have a real opportunity to build a real business.
Yeah. So, as you take a look at what happened in the Planet Network, where entrepreneurs bought up area developers, once they bought that development territory, they started to borrow money, personally guarantee it, open up 10 or 15 leases, personally guarantee it. And then private equity says, hey, these unit economics look pretty interesting. And you got a territory that you own exclusively as Planet, was kind of the first to say, like, hey, it's kind of like a cash register. And it's not that hard to run because I'm not running any Group X. I'm not running any personal training. I'm not running any daycare. I'm not running any pro shop. When private equity looks at that and says, hey, look, I want to go and partner with one of these, a CEO, from your standpoint as being an independent sponsor, you've got some, pros of like, hey, partner with me because look, I'm going to be along on the ride here with you. I'm going to help you manage this business. I'm going to help you interface with a private equity or my investors. Talk about the difference between like a private equity firm doing an area developer deal in like Planet or Crunch and you as an independent sponsor cutting a deal and then going out and getting the capital, but you staying on with the deal is almost like obviously a board member, obviously like an intermediary to an extent, and also like a buffer and a benefit to the management team. Where it's like, hey man, you don't have to do a private equity deal. It's like you and the private equity firm. I'm actually here as like a conduit and a bridge that's going to help raise the probability that we're going to get through whatever we need to get through together.
Yeah.
How do you think about that?
Here's how I would answer. I actually operate a little differently than most independent sponsors. What I don't do is I don't court a founder or a management team and try to lock up a deal and then go dial for dollars. What I actually do...
No, I wasn't implying that.
But that's how most independent sponsors act. Yeah. I actually operate a little differently, which is I go, look, all of the processes I'm involved actually are not processes. The processes is a courtship process because the vast majority of transactions which I pursue are, they're all relationship based or cold calls or cold emails where relationships were established over,
years.
Months, if not years, right? And so what I do is say, hey, look, I'm interested in helping you recapitalize your business or acquiring your business. And, what are your goals? And by understanding your goals, I can help bring alternatives to the table. And what I do is I say, look, again, rather than locking you up into a deal and then dialing for dollars and trying to get that deal financed, what I do is I bring various alternatives so that the founder or management team or owner can make a decision as to, hey, this is what's most ideal and best for me, and then say, okay, I can get that. What I'll do is I test the market on a very curated basis, and so I bring back what the market has to. So
you're kind of like a hybrid between like I'm your advisor and your banker, and I'm also like your independent sponsor option.
Right. So
with a private equity fund to say like, let me show you like the buffet.
Right.
And I'm not fronting that my buffet is going to be the winner. I'm like giving you what the market says.
What I try to do is say, look, here's like as an example, here's maybe a majority option, and here's a minority recapitalization option, and I'll speak to the right number of parties, and that might be 3 or 5 parties under either option, so that we can present options and people can say, look, I like this or I like that, and then I will work with these various groups to present, alternatives to, again, a founder or management team so that they can pick what's best for them. But unlike a banker, I stay involved. So I co-invest in the deal. I sit on the board. Like on the Crunch Fitness franchise that I'm involved in now, I'm on the board. I act very much as kind of a coach, mentor, to our CEO. I act as our CFO. I deal with all our capital markets, and I'm, the interface directly with our, family offices and institutional capital partner that is involved in our platform.
Gotcha. So, as you take a look at going into Crunch, let's talk industry-wise. You got in at January 2020, not great timing. However, you did have a partner in Seacoast, and I'm sure they have the word flexible on their website. A lot of guys weren't flexible during COVID and, when they stopped getting paid. So how do you think about, picking your partner with people that have done multi-unit in the past, people that you have relationships with? What's your criteria to say to that entrepreneur, hey, here's all your options. If you do a deal with me, I'm going to do a deal with a group that is like-minded, or it's not just...
Yeah, well, that's a good question. And one of the things that I share with people is, look, as I present alternatives, economics are part of it, but there also has to be a good cultural fit,
Right.
because most of the transactions I focus on are more, they're going to be more of a partnership rather than an entire sale or buyout of a company. And so I said, look, you're not just selling your company for the highest price and moving on. You're entering a partnership. And
Yeah.
so, understanding the terms of that, not just economically and structurally, but just kind of culturally, is a big deal. And so, fortunately, as you know, there's no shortage of investors who are interested in getting into this space. And so, we collectively have relationships with many, but we know there's a short list of folks in which we think will be the right fit for any particular situation.
And that they've also looked at other deals, and you don't have to get up to speed
Yeah,
with them on the
they
entire
people that know
industry.
the sector,
Yeah.
people that have the experience in the sector, and also people that have had challenges in the sector. Because as you know, everyone's a great partner when things are going well, but you really find out how good your partners are when you're challenged. And so, we were just talking a second ago. You brought up the fact that Seacoast Capital is my institutional capital partner on our Crunch Fitness franchisee. Seacoast is an unbelievable partner. I mean, they basically financed a minority recapitalization of 21, Crunch locations in January 2020. Everything was going, fantastic for 45 or 60
Yeah.
days until the world shut down.
It's like a
And,
shortest
you know,
private equity honeymoon.
yeah, well, there's a couple examples of, look, the Prospect Hill Crunch platform. I think those guys closed, later in January, beginning of February. So they
Yeah.
actually
Yeah.
they actually flew even closer to the sun, the
Right,
COVID
right,
sun.
right,
But
right.
to your point, like Seacoast, they funded half their investment at closing and half their investment really subsequent to closing, and they adhered to the terms of the original deal. I mean, talk about amazing partners. I mean,
Yeah.
just patient, flexible, backing you in tough times. I mean, those types of partnerships, that's not what you find across the board, as you know. And so, people like that obviously have the long view. Relationships are important, integrity is important, and just maintaining their word. And so they've been an unbelievable partner, and obviously someone I would would partner with rapidly, eagerly again.
Yeah. One of the things that I've seen over the years that has gone wrong with private equity funds doing deals with management teams or an owner, and the private equity fund ends up buying majority control or like 49% control, whatever it is. The CEO of the company thinks that they rented capital, and the private equity fund thinks that this guy or this woman's under an employment agreement.
Yeah.
And I feel like if you don't understand what the relationship is the day after closing, you're probably gonna at some point butt heads of like, hey, am I running money for you, or are you working for me because I'm running the money? So
Yeah.
how have
Look,
you kind of like laid out and
it's a
established
great-
like, hey, this is how shit's gonna go?
It's a great question. I mean, look, it's all about managing expectations and also picking a good partner. But I mean, I can think of a lot of very successful private equity transactions, either majority or minority deals, where the partnerships have worked out unbelievable in good times and bad.
Yeah.
And then, but I also, I'm very familiar with situations where, actually, as you alluded to, just the perspective of the private equity now owner and the manager, the entrepreneur or CEO, who now feels like more of an employee than that entrepreneur or majority owner in the past. Those there's a conflict over time, and things. I think of an example of I have a very good friend of mine who sold a business in the healthcare space, who very successful exit, sold 60 or 70% of the company to a very well-known private equity fund, and within 12 months of closing a deal, they're butting heads, and the CEO stepped down, and he still owns a ton of equity, and
Yeah.
he'll stay on the board, but the relationship dissolved really quickly.
Yeah.
Um,
I feel like ownership disputes tank companies more than like management like strategy dispute. I feel like once there's like a toxicity at the board level, it kind of somehow like drips down like a flood.
Well, yeah, I don't know if I could compare the two, but there's plenty of examples of, look, if you don't have a healthy, collaborative, cooperative environment at the board level, it's going to cause problems. We actually have a very interesting board dynamic at our Crunch platform. We have a disparate minority shareholder base, meaning we have two large family offices and one institutional capital partner, plus a CEO who exchanged. He sold his company into our platform, and so in exchange for a bunch of equity. So we actually have four very large yet minority equity holders, and somehow our board and corporate governance works. But I'd say that that dynamic is unusual. But it is collaborative, and it works. But obviously, those relationships, if they dissolve, that toxicity can filter down real quick.
Yeah. Let me ask you two more questions, and obviously you and I can riff for hours here. But I really want people to understand and get a couple of takeaways from private equity, the benefits of doing it, the professionalism you get. The one thing I want to ask you about is, there's a lot of franchisors out there that, want to become the next Massage Envy and want to become the next Orange Theory. You could say F45, like they were gangbusters. If you saw their public company stock, you'd be like, oh, I'd love to be a franchisee of F45, until you actually did the work and realized that you don't want to become one because the unit economics don't work. So, over the years of doing this, how much do you trust your gut, or interview, or read through, hey, who's the franchisor? Who's my ultimate parent company partner? Because you've got a really interesting, almost like a rectangular relationship between landlords, franchisor, franchisee, and equity group, and probably a debt group in the middle. It's almost like a hexagon or something, about all these relationships. So how do you think about diligence in a franchisor as a sponsor, as a private equity firm, as a manager, and be like, hey, I don't know if I trust these guys. Like Planet Fitness back in the day, you go up there, they had a beer keg, and they had calendars. You'd be like, dude, I don't know, man. This is a little bit crazy for me.
Look, I think you ask a good question, particularly now where the franchise model is so popular, right?
Yeah.
And so it's expanded so greatly within health and wellness, on the success of everything from planets to exponential. Look, the diligence on the franchisor is that is an important part of diligence. I mean, look, as a franchisee, you have a playbook, you have your territory, and you have you better like that playbook, and you better like the folks that drafted that playbook, and you better those unit economics better work, and that playbook has to work. And so if you're not comfortable with kind of the genesis of that, then you have an issue. Now, fortunately, I actually met Mark Mastroff and Jim Rowley many years ago, and had a great deal of respect for what they've done in this industry and how the industry has evolved over time. And so I felt like I had a leg up because of a pre-existing relationship where I was comfortable with them as individuals, and could, and they also would give the time up front to answer questions for myself and our capital partners, so that everyone was comfortable with what our strategy was and what our goals were within our market.
Yeah. And then, as you think about, exits, and you think about, the time horizon, North Castle just did a deal where they basically wanted to hold on to their portfolio company and had a continuation fund. There's several of those types of deals where there's a big Planet Fitness franchise area developer that private equity firm doesn't want to let go because it's great business. So how do you think about maybe in this new private equity environment, and maybe more traditional business norms with higher interest rates, maybe less economic growth? Maybe a 10-year hold isn't a crazy idea if you got a really good business, instead of going and selling this one and trying to find another one.
Yeah, well, I fully agree with that. I mean, I think one of the deficiencies in the private equity model is that pressure to sometimes monetize prematurely because of just the fund raising cycle. So I actually agree, when you have a good business and you continue your growth trajectory, or maybe you're just operating in harvest mode. If you have a good business with good unit economics, unless you're forced to deploy that capital elsewhere, I am a big fan of that long-term hold. And so for something like this, in my situation, as I mentioned earlier, we have this disparate minority shareholder base where I have different shareholders who very likely have different goals and timelines, which we will respect. And so honestly, one of the jobs I do is, as kind of like acting CFO and dealing with all our capital markets and presenting various options over time to our partners, is, look, the CEO and I, we love doing this, and we're very much, right now we're 34 locations. My gut tells me, we're going to open up 8 locations this year. We have some M&A in our pipeline, so we should be. I'm hoping we're at 50 locations within the next 18 months or so. We got a lot of fire in the tank, but some of our investors may have different goals and timelines. So my only goal is to make sure that we always have, one, a capital structure to support our growth plan, and two, also have the capital structure in place to provide our shareholders options over time in the event, if and when they want to exit over time. And the CEO and I, we say it to ourselves, we tell each other all the time, hey, so long as this is fun, we'll keep doing this.
Yeah.
So
No, it's great. That's great. Well, let's make this part one of our multi-unit series of
Let's do it.
podcasts. So we banked our first 20. Good to see you again in person. Hopefully we'll
always
work
a
on some
pleasure.
deals together.
Let's do it.
And welcome to the Halo sector in a big way. And if you got questions about how independent sponsors works, private equity, and you want a second opinion, I'm gonna set you up with Eric. So
Please do.
Good stuff, man. Good to see you.
Thanks, Pete.